All right, guys. Well, I think we'll just kind of get started here, and hopefully we have a few more people jump on. But like I said, I want to be respectful of your time and for Josh's time. We're so happy to have you, Josh. This is going to be awesome. I remember one thing from your article that said most agents understand the first part of getting a loan for their clients, enough to help them buy the home, but they don't really understand what happens after the loan closes. And it's so true. I talked to you, I talked to Corey, I talked to my lenders, and there's a lot I don't know. And so I'm really excited to have this class. We've got at least an hour. We'll do some Q&A with you guys. Our next class isn't till 1:30. So even if we run over a little bit on one, we're going to be okay. At 1:30, for those of you that there might be some of you here that are going to attend that as well. It's just our EXP brokerage model overview, which we'll do at 1:30. So I may log off and then log back on. But like I said, we're happy to have you, Josh. I'm going to turn the screen over to you, but Josh is an amazing lender. I've known him for over 15 years. He's a friend. He's a lender, nationally known lender. He's in all 50 states. Definitely has an inside view on what he's going to be sharing with us today. So you guys, I commend you for being here and increasing your knowledge of the industry so we can better serve our clients, right? And we don't worry about retaining all this stuff because it's not our job, right? I mean, we need to know enough to where we then say, like, okay, it's time to pick up the phone and call our lender, right? But this will give you a good enough view that there is a situation going on right now that we may not be privy to. So Josh, I appreciate you. I'm going to let you share your screen if you need to, or take the mic, and I'll turn it over to you.
I'm going to do that. Thanks, Jeff. I'm excited to be here with you. I'm going to share my screen real quick. You see that scary virus picture?
Yep, just popped up.
Okay, all right. So again, thanks for having us. I'm joined by Vicky, who is a loan officer on my team. Some of you may know her. She's here as well. She'll help out in the Q&A. I've also got Andrew and Colin. Those are my marketing partners. And so really there's three things that we wanted to do for you today. Number one, I wanted to help you understand why lenders across the board are tightening underwriting standards. And you may have noticed some loan programs have already gone away. So there's what's called a non-QM loan, which is a non-qualified mortgage. That's if somebody has maybe a higher debt to income ratio or needs to use bank statements instead of tax returns, or has some credit blip that wouldn't fit within conforming guidelines. Those would go to a non-conforming or non-QM type loan program. Those have all been basically obliterated already over the last couple of weeks. And now we're starting to see conventional loans, bond loans, government loans, the credit box is starting to shrink. And so to Jeff's point, I'm gonna try and explain to you as succinctly as humanly possible what's happened in the secondary markets and why we're seeing that credit box tighten. The second thing we wanna do for you is we wanna give you, both on the listing agent side and the buyer's agent side, I wanna give you a real tactical formula which you can apply that will do two things. Number one, on the listing side, it'll help you from getting deep into the transaction and have deals blow up, because I guarantee you that's going to happen in 2020. So I'm going to give you a real tactical plan to follow so that you can avoid having that happen, or at least reduce your chances as much as possible. And on the buyer's side, I'm going to give you a similar tactical plan. And I want to make sure the same thing. We don't get deep into a transaction, run into an issue, lose borrowers' earnest money, lose them their home, and then of course lose you all your precious time that you've invested. So I'm going to give you some tactical implementation things to put in to protect yourself and your clients. And then last but not least, Andrew and Colin are going to share a few of their marketing techniques that they're using right now with some of our referral partners that are creating leads in this environment, because we know we're not out, we're not having face-to-face meetings, we're not at barbecues, we're not having that human interaction like we used to. So we're going to show you what we're doing online for some of our referral partners to help them create some leads. So far, is volume okay? You guys can see my screen. I'm a green light.
Yes, yeah, okay. Great. Yep,
perfect. All right, perfect. I got the thumbs up. Thank you. Okay, so the next graph I'm going to show you is the U.S. weekly initial jobless claims by thousands. So on the left-hand side, you'll see a number that represents thousands. And I want you to watch what this chart over the last, I think it's over the last 60 or 70 years. So here we go. So in the 80s, we got as high as 700,000 unemployment. Then we're going to hit the Great Recession, almost got to 700,000 unemployment. Uh-oh, what just happened? 4 million, 5 million, 6 million. Pretty scary, right? So this is the initial jobless claims. And so the question is, how did a Chinese-born virus cause a mortgage crisis in the United States? So I'm going to kind of just walk you through the timeline of what happened and how this evolved to affect not only mortgage lenders, but see what happens in the mortgage world is most mortgage lenders don't retain those loans. What happens is those loans are bifurcated and the servicing is sold to one company, and the actual mortgage-backed security is bundled and then sold to Fannie Mae and Freddie Mac. So the lender, like Fairway in our case, that's the company we work for, we underwrite the loan, we fund the loan with our own money, we package it up, we make sure it's ready to sell to Fannie and Freddie. Then we sell the servicing to one company, and then we bundle the loans and we sell the mortgage-backed security to Fannie and Freddie. Now, why do mortgage companies do it that way? Because it's the cheapest access to capital. If you want the lowest interest rates anywhere in the country, you want a Fannie or Freddie or Ginnie government-backed mortgage-backed security. And the way to do that is to make the loans up front, have one company service them, bundle them as mortgage-backed securities, and then sell them to Wall Street. That's the access to the cheapest capital. But what happened as fear around the coronavirus grew in the financial world, the stock market pulled back faster than any time in history. There was a 38% decrease in the stock market in 27 days, which is the fastest decline of all time. Now, interest rates sunk, which is what we would anticipate to happen in any kind of an economic slowdown or recession, which is usually why real estate does really good in recessions, because there's fear in the marketplace, but interest rates are going down, and all of a sudden housing's super affordable. So these low interest rates started triggering a massive refinance boom. Lenders had the biggest pipelines. For example, Fairway did $39 billion in loans in 2019. There was a period last month where we were locking $1 billion a day. So that would be like 200 billion. So imagine growing from 39 billion to 200 billion. It was like an incredible refinance boom that was happening. And so as lenders' pipelines were huge with all these refinances, rates continued going lower, and it's resulted in some massive margin calls for lenders. This is kind of a liquidity crunch. I want to explain this to you because I think it's fascinating. Not like Jeff said, not that you need to necessarily take this into your day-to-day job, but I learned more in the last 30 days around mortgage than I have maybe in 20 years. And so I've kind of geeked out on it, and I just want to share with you. What happens with a mortgage is we go out today and we lock a client at, let's just say 3.5% interest rate. But we're not going to deliver that loan as a mortgage-backed security and sell it to Fannie Mae and Freddie Mac for 30, 45, maybe 60 days, because maybe after the loan closes, there's some post-closing stipulations we have to clear up before we can sell the loan. Well, let's say between now, when we lock the client at 3.5, and in 60 days from now, let's say that interest rates have gone to 4%. Uh-oh, I already promised the client 3.5%. I can't renege on the deal. The mortgage company would take a loss if there was interest rate fluctuation. So what a mortgage company does is they hedge their position. They say, I'm going to take out a short position on mortgage-backed securities so that if interest rates go up or interest rates go down, I am protected. I don't have to worry about any of that interest rate fluctuation from the time I tell a client their interest rate is locked and a time that the loan is actually sold to, securitized and sold to Fannie and Freddie. Well, what happens is when interest rates went down very quickly and lenders across the country had their biggest pipelines of all time, they had what's called margin calls on their short positions or their offsetting hedge, what's called a mortgage hedge. Those short calls, just to give you an idea, Fairway had $157 million in margin calls in 1 week. So lenders all around the country are in a liquidity crunch. They're kind of in a cash crunch right now. Now that should all clear up. Once those mortgages are sold into the marketplace, they'll get their money back from those margin calls, but it has caused some lenders to go out of business. We've seen that already happen in the non-QM space. And again, I'm just kind of walking you through this in terms of giving you some background. All right, so now I talked to you a little bit about that was the mortgage lender. And then I mentioned to you after the loan closes, there's two assets that are really sold off into the marketplace. One of them is the servicing. So when a servicer takes a loan, all they're doing is collecting the principal and interest, the taxes and insurance. They're making the annual tax and insurance payments to the county and to the insurance agent. They're making sure that they send out statements every month, and they are essentially just facilitating that transaction being paid. The actual asset, as I mentioned, is sold off to Fannie Mae and Freddie Mac, securitized, and then often resold on Wall Street to pension funds, and they actually own the mortgage-backed security, the asset. Now, what's interesting is the terms in those servicing agreements state that the servicer is responsible for making that payment to the end investor that owns the mortgage-backed security, regardless of if the payment is being made or not. And in most cases, it's not a big deal. In most cases, the servicer collects enough of those payments that they can continue making payments to the owner of the mortgage-backed security. And in the case that there's a default, they've got enough liquidity there, they can make those payments to the servicer, eventually foreclose on the home if they have to, and then get repaid, claim mortgage insurance, however they're going to dispose of that property. So what's really interesting, what happened to servicers is that the mortgage loan servicers saw the value of their servicing portfolios cut in half in a matter of weeks because of this huge wave of refinancing. So think about this. If you're a mortgage servicer, you make a portion of that payment each year. It's called a spread. You make a portion each year, and it takes you about 3 years. Once you've purchased the servicing, it takes you about 3 years until you recoup your initial investment. Well, with these rapid drop in interest rates, people were refinancing really quickly. And instead of holding on to the loan for 5 to 7 years, which has kind of historically been the norm, now people were refinancing every year, every 6 months. I mean, I don't know, I refinanced half the clients I did loans for last year already this year. So the value of their servicing portfolio went down because people weren't keeping their loans as long and they weren't earning that margin for as long a period of time. This created a little bit of a liquidity crunch for those loan servicers because if they have less asset value, they can borrow less money. So this kind of put just like on your house, if your house value went down, those of us who had home equity lines of credit in the last mortgage meltdown, you saw your equity lines get frozen because the asset value was going down and they froze the home equity line. Jeff, did you have any home equity lines frozen in the mortgage meltdown?
Home equity lines frozen and lines of credit canceled.
Yes, so I had the same exact thing. And this is the same concept. The value of the portfolio went down, and then you have the liquidity that's available to those servicers go down. All right. So, and I already mentioned that the servicers are on the hook for making the mortgage payments to the owners of the mortgage-backed security, regardless of if the client has made the payment or not. Well, we just saw what's happening to the unemployment numbers skyrocketing. That means more first payment defaults, and it means more people applying for forbearance. All of that creates additional liquidity crunch for those servicers. So now what you're seeing, those servicers don't want to purchase the servicing rights from lenders due to the skyrocketing unemployment, and they're now instituting tighter underwriting guidelines. So your mortgage lenders have had a liquidity crunch. They're worried about taking on any bad loans. They're tightening the credit box. The mortgage loan servicers that are on the hook to make the payments to the investors that are eventually going to own that mortgage asset, they don't want to take on any more risk, and they're really fearful for this drastic increase in unemployment. So they're starting to say, hey, our credit box is getting smaller. So in other words, big picture, everybody is saying liquidity's down. We're worried about unemployment. We're tightening the credit box. It's just risk off. You know, I saw an article today in the New York Times that Americans have more money in their checking accounts right now than any time in the history of the country. That's because everybody's saying less risk, I'll hold on to cash. Same thing's happening in the mortgage market. So what should you do? How do you protect yourself? All right, so for listing agents, I'm going to give you, and I'll send you this slide deck, by the way, but I'm going to give you some tips, and then I welcome you. I'm going to probably pause before I turn it over to Colin and Andrew, and I'll just open it up for questions if any of this isn't clear when I get through with my advice for listing agents. And the reason why I think this is important for listing agents is if your buyer is getting financing to purchase your listing, these are some things you can do to protect your seller and also protect yourself to make sure you don't get deep into the contract and then find out, whoops, this tightening credit box made it so the borrower who maybe could have applied in March can no longer apply in April with the tightening guidelines. All right, so here's what I would suggest. These would be my suggestions. I would require a pre-approval letter and automated underwriting findings dated within 48 hours of the offer being submitted. Why? Well, I'll give you a perfect example. I had a client that has mediocre credit. He was in the 620s. We put him on a credit restoration plan. We got him up to 660. Well, at 629, I think it was, we ran underwriting on him 2 months ago, and I got an underwriting approval. We just re-pulled his credit yesterday, got him to a 661 score, re-ran underwriting findings, declined. Fannie Mae and Freddie Mac both tightened their automated underwriting credit box to the point that a 620 qualified 3 months ago and a 660 today didn't qualify. So we're still trying to figure out, can we come up with more reserves, more down? But the automated underwriting systems directly from Fannie Mae and Freddie Mac are tightening, and the people who may have qualified before may not qualify now. And so I would ask anybody making an offer on one of my listings, I want the pre-approval letter and I want automated underwriting approval that is dated within 48 hours. I would require verification of their current credit scores within 30 days. Here's what I'm seeing in the marketplace. I'm seeing the different investors and the different servicers that used to go down to 580. Many of them are increasing their credit score requirements to 640 or 660. Now, there are some lenders who have not increased that credit score requirement yet. However, I believe in the next 30 days, as they have a hard time selling these loans to the servicers and getting them off their warehouse lines, they will eventually increase those scores. So if you take an offer from somebody and they've got a 620 FICO score, they may qualify now, but that doesn't mean that their company is still going to be around doing business or going to be able to do that loan down the road. So I would start to be, somewhat nervous of anybody making an offer on my listing under a 640 credit score. There we go. All right. So be aware of FICO scores below 640 and debt to income ratios above 45%. Anything less than an A- loan is highly susceptible to a decline today. So debt to income ratio is the other big key that we're starting to hear from underwriting. And of course, this is coming all the way down from the servicers that don't want to purchase this loans. Hey, listen, if these clients are already tight in terms of their overall debt to income ratio, what happens if one of their incomes is impaired because of this crisis? Let's say they don't lose a job, but let's say they go on some sort of a reduced hours, or they have reduced commissions, or there's some sort of impairment to income. So we're going to start to be a little more conservative with what debt to income ratios that we approve. Now, by the way, if you ask for the automated underwriting findings, it will tell you their debt to income ratio. It'll show that on the underwriting findings. So anything over 45%, personally, if you got another offer, I'd take the other offer because I think you may have a hard time closing that deal. And I would ask for documentation of down payment and some reserves. What we're starting to see is some overlays, not directly coming from Fannie Mae and Freddie Mac yet, but coming from the servicers that we're selling these loans to. And basically what they're saying is, and this is pretty common sense, they're saying, look, in a normal market, we're not that worried about reserves because unemployment is so low, they can go find another job. In this market, I mean, it may be really tough for somebody to find another job. How do they go apply? I mean, of course they can do it online, but it would be more difficult. So we want to start to see that not only do buyers have their ability to put their down payment, but we want to see maybe 1, maybe 2, maybe 3 months, depending on the factors of the loan, liquidity post-closing, so we know that these clients can make their payments if, heaven forbid, they lose their job. So again, you know, if you only have one offer on the property, maybe you take what you can get. But it's certainly, if you have multiple offers, I would be as discerning as possible, because telling somebody no up front is a lot better than 30 days under contract finding out that after all they can't do the deal. Now, the other very, very important piece that is changing, these are changing day by day, is that we need to start thinking about, and we're hearing from our underwriters that as loan officers, and so I think realtors as well, need to start thinking about the industry that our clients are in and what is the likelihood that their job may get cut or their income reduced. In other words, if you are in the service industry with a 45 debt to income ratio, no reserves, and a 640 FICO score, I don't think your deal is going to get done. You know, that deal could have gotten done no problem weeks ago, 30 days ago, but the next 30 days, the next 60 days, over the next 12 months, as we continue to see initial jobless claims go higher, underwriters are going to be thinking about that. Because if you put yourself in the place as a lender for a moment, if I'm making a loan to somebody and they don't perform, they don't make their first payment, or they immediately enter into deferment, I can't sell that loan. That clogs up my warehouse lines. That puts me out of business. So if underwriters are starting to really think this way, I think you as realtors need to start thinking this way as well. And day of closing, VOE, verification of employment. Unfortunately, this is going to bite a few of us in the butt this year. It used to be that we would do paycheck stubs, W-2s, if you're self-employed, tax returns, and then we would do a verbal verification throughout the underwriting of the loan. Well, now there is a second verbal verification of employment that's done within 24 hours of the loan closing. This is problematic for 2 reasons. Obviously, if the person lost their job, or in the interim period of being under contract, their hours were reduced or their position changed, that's going to come to fruition in that verbal verification of employment and could blow up your deal. But the other way that this could impact your transaction is, I would anticipate, I see a chat there I'll get to in a minute. I would anticipate that we're going to see a lot of these verification of employments coming in from mortgage lenders, and people in HR may get overrun with these requests and might not be able to respond fast enough. So picture this: loans approved, CDs out, clear to close is given, docs are going to the title company. It's the day before closing. Lender is now calling to verify employment, can't get the HR person on the phone. Now day of closing comes, still can't get a response from the HR person, no closing. So just be aware, and we're letting clients know in our initial email that this is something they need to be aware of. All right, other note I had on here. How quickly can the lender clear contingencies? Team, with the mortgage world changing this fast, to me, the faster you can close a deal, the better. because loans that I had available 2 weeks ago, I don't have available today. And if unemployment numbers continue to go up, the credit box will continue to constrict, because lenders will want less and less and less risk in the face of these increasing jobless claims. So if you can close a deal in 17 days, that's a lot better than closing a deal in 45 days. So I would be pressing lenders, how quickly can you clear those contingencies? And I'd be asking them, how quickly can you close? If they've done a recent full pre-approval, they should be able to clear those contingencies fast, and they should be able to close the transaction fast. If they haven't touched the loan for 3 months and they have to gather all new documentation, well, then they got a problem anyways, because they need to repull credit, rerun automated underwriting. They don't even know if that client's going to approve now that the credit box is shrunk. So that's the end of my advice for listing agents. I have a few more things I wanted to say to buyer's agents before I turn it over to Colin and Andrew, but I'm going to pause for a minute. Does anybody have any questions that I can answer?
Josh, I have one in regards to loan products that are going away and changing. Did you mention what's happening to the jumbo market? Jumbo loans?
Yeah, so, jumbos are on again, off again. But what we've started to see is a little bit of increase in the interest rates for jumbo loans. Fairway actually took jumbos off the market altogether for about a week. We're rolling those back out next week. But really what we wanted to see was, what assurances do we have if we're going to fund a jumbo loan? Because we're a correspondent mortgage lender, which means we underwrite, we fund everything on our own money, on our own warehouse lines. We really wanted some assurances that the investors on the back end were going to be around to buy that paper. So Fairway said, hey, we're just not going to do this for a week. We want to go check our reps and warrants. We want to check what's going on with our jumbo investors and get some assurances that if we underwrite to your specifications and you allow us to lock a loan with you, you're actually going to buy the loan. Again, the way mortgage companies go out of business, they do a bunch of loans. They can't get it off their warehouse line. They can't do new loans, and boom, bankrupt mortgage companies. That's how companies go out of business, and how we saw so many go down in the mortgage crash. So I would just say in the jumbo space, you're going to see continuing shrinkage of the credit box, and it's going to be, A and A- borrowers only. Anything with any hair on it in the jumbo world is not going to fly.
So basically, whatever your answer is today, it might be different tomorrow.
That's exactly right. Yeah, no, that's 100% right. And so I guess, how do you protect yourself with that? If the lady has 800 FICO scores and 50% down payment, and let's just say they're a doctor, you got a pretty good chance that deal is going to go through. I don't know, I'd be nervous. But if it's a 80% loan to value, and the gal owns a string of restaurants and she has a 680 FICO score, I'd be wanting a lot of earnest money, and I'd be wanting that, those financing contingencies to be released pretty soon, because there's a decent chance that buyer's not going to perform, and I would want my seller to be somehow rewarded for taking the property off the market. Did I answer that question all right?
Yep. But here's another thing I'm hearing on that as well, is from the listing side, generally we're reaching out and talking to the buyer's lender, right? Yep. We're trying to get validation of the pre-approval process they've already gone through, and the stability of their client. I think it's even more important, and I think this is echoing what you're saying, that even on the listing side, it's okay, I'm going to call their lender, but I need to call my lender as well. I need another opinion, right?
Heck yeah. And I would be so bold as to say, look, we all know what's happening in the mortgage world. It's shifting right underneath our feet. I need some assurances beyond, a warm and fuzzy phone call with your lender that your borrower can perform. I don't think it's too much to ask to have your lender validate what's their field of work, what's their debt to income ratio you've calculated, what documents have you, because in a jumbo world, there isn't automated underwriting. So, they'd have to give you something, something to confirm these things, maybe an email and hey, in a commercial deal, Jeff, very well that they all want to see proof of funds. Like we're always getting an approval letter from a lender, and then, here's my TD Ameritrade account. So I would just be stepping up my game in regards to what due diligence I'm doing. And then anything that's a red flag, yeah, to your point, Jeff, hey, buyer's lender, my lender's going to call you and going to ask you some questions, and have your lender that you know and trust and is adept and wants to protect you to call and ask the right questions. I think that's a good strategy. Cool. All right. If there's no other questions, y'all, feel free to use the chat. Vicky also mentioned in the chat that she had a client whose year-to-date income was reduced, and we're having to wait for her to go back to work full time. So basically, she didn't get let go, but it's like a furlough where you just work less hours, and we're looking at the trend in the employment income, and it's going down. We're going to run into those, and we're going to have to wait until that levels out and goes back up before those clients are going to be able to get loans. All right. So on the buyer's agent side, I'm going to move through this a little bit quicker. Similar advice, but just a few different tactical steps. I would tell you that any pre-approval dated before April 1 is essentially null and void. The mortgage market is really changing that fast. So anybody who you had approved in March or before, I would be talking to the lender and I'd be saying, how old's your credit report? And when's the last time you ran automated underwriting? Usually you can rerun automated underwriting with usually a credit report's good for 120 days. So if that credit report isn't, and again, that's 120 days from closing. So if that credit report's not within 90 days and they haven't rerun automated underwriting in April, I would be asking them to do this, because the credit box has really, really narrowed over the last couple of weeks. So I'd send all buyers back to the lender, update the credit, rerun automated underwriting, and find out if they still qualify. And I know that can sound harsh, but hey, I'd rather find out now than 3 weeks under contract. I'd also be putting a little bit of thought into what line of work your client's in. Is the buyer's job likely to be impacted? If you're a server, you're having a hard time, and you were qualified in March, I'm telling you, you're not qualifying in April. So you really need to think through, is that job going to be around? And don't forget, there's a day of closing verification of employment. And here's where it gets really, really dicey for buyers. Inspection money paid, appraisal money's paid, earnest money's hard, and 3 days before closing, the employer comes down and says, hey, I got good news and bad news. We're not letting anybody go, but everybody's on furlough, and you're going to be working at 80% of your previous pay, or 70%. That deal is not going to close. So there are some risks there, and it would be good to just talk through those things with your client. Like, hey, are you hearing anything about your company laying off or reducing hours? Is your bonus, is your commission, is your overtime, is any of that decreasing based on what's going on in the world? And if they say yes, sometimes clients won't tell that to their lender because they don't want to get caught. Trust me, they're going to get caught. This stuff is getting flushed out in underwriting. So it'd be good to have those conversations up front. All right. So there is some upside to this. And so how do you dominate as a buyer's agent in today's market? Well, I think that you have the lender send with the offer. If I was a buyer representing a buyer, I'd want to send updated automated underwriting approval showing I just ran these underwriting findings as of 4/6. Here's a snippet of their credit score. Lenders can usually do that without revealing their social security number. By the way, here's a snippet of their bank statement showing they've got the down payment plus reserves. And oh, by the way, we've gone through a full credit and income underwrite. We'll close this deal in 17 days or less. I think if you start presenting offers like that, you have a really good chance of either A, getting a price reduction, or B, winning out in the instance that there's multiple offer situations. the stronger you can make your client look. This is going to become more and more of an issue as you go through the year. So the stronger you make your buyer look, the more appealing it's going to be. All right, that's all I got. We've got a little bit of time left. I'm going to turn it over to Andrew and Colin, but let me see if there's any other questions. Or Jeff, would you add any other advice there?
Well, I think the advice would be just to remember what our main job is, and that's to protect our clients, right? So they don't know what they don't know. That's why we're doing this, right, guys? So we're learning as much as we possibly can, and then having our professionals to refer to. But what Josh, just to echo what he just said, make them aware that things are different, because they're going to think, hey, I'm pre-approved, I'm good to go. They need to know of hiccups and things that can happen in the future. The worst thing we want to hear from our clients is, why didn't anybody tell me that, right? I mean, I say that all the time. Why didn't somebody tell me this could happen? Like Josh, you just mentioned, paying for inspections, paying for appraisals, money out of the pocket that they may not have a lot of extra of. And then these things happen. They're going to want to know that that's a possibility up front. So to everything you're saying, this is great information, Josh. It's just like, check and double check, more so than we ever have in the past. And even like we're talking about right now, what we're hearing today might be different tomorrow. And so those phone calls and those relationships are going to be even more important moving forward.
Yeah. You know, as you were talking, I was just thinking, man, a great phone call on the day of the financing and appraisal deadline could just be a phone call to check in and say, hey, your loan looks like it's moving well. Everything's great. Your inspections are all passed. Appraisal's in. Title looks good. We're rosy. How's your job? You know, like, are you hearing anything down the pipes? Did the lady next door and the guy to the other side, did they get let go? And might you be next? I think this is really that time to shift our perspective a little bit and ask questions at a deeper level than we were before. And I'll tell you what, I think that clients will feel that care and feel that, you know, that you're really looking out for me. And I think that could be a real win for people who navigate this right. Okay, so allow me to introduce Andrew and Colin if I could. Guys, can you hear me?
Yeah, can you guys hear us?
Perfect. Are you in New York today, Colin?
I am. I just traveled there just recently.
Nice. Well, clear skies behind you. You're looking great. Andrew, are you around, bud?
Yep, I'm here.
All right, wonderful. All right, so these two gentlemen are, they run all of the marketing for our branch. And last year, between the two of them, they generated about 10,000 online leads from our different websites, social media strategies, past client reach out. And this year, the numbers are way up. They're on track to generate about 15,000 leads. And over the last couple of months, what they've started to do is to advise and facilitate some of the realtors that we work closely with and help them figure out, how do I keep leads coming in when I'm stuck in my house or it's not okay really to get together socially. So with that, I will, if it's okay, guys, I'll keep the screen so I can change it for you, and you just tell me when you want to change. Is that all right?
Yeah. Yep.
All right, very good. Take it away.
So I just want to first start off by saying right now is definitely a time that everybody needs to make sure they're getting out there in front of people. If not, we're a good possibility of disappearing, especially since everybody's hiding at home. So take advantage of online marketing. And I first would like to hand it off to Andrew. He's kind of the lead on our realtor digital audits. So he's got some really awesome tips for you guys.
Thanks, Colin. So yeah, just like Colin said, now is a great time to really analyze your digital marketing strategy and figure out what works as you're pivoting to kind of meet the new demands of your client base. So one of the questions we get a lot is how can I leverage digital marketing during a time like this where really digital marketing is your only option? And with so much going on, you know, people losing their jobs, the economy's in a shaky situation, it can be easy to get into a kind of analysis paralysis and kind of start to overthink every single marketing message you're putting out so much that you just end up not doing anything. And that is the exact opposite of what you want to be doing right now. Now is the time to actually start upping your frequency, and instead of backing off, just start putting more messages out there. At our Fairway branch, we've actually started, I think about 3 weeks ago, we started posting on social every single day and creating blog content every single day. And we've seen a huge uptick in our traffic and in our engagement. And like Josh said, in our leads. And the reason that we started to see this is because people are on their phones and their computers all the time. You know, back before the coronavirus crisis, when people were checking their email, checking their social media infrequently, it was okay for you to be marketing infrequently. But now that people are on their electronic devices all the time, it's so important to make sure that you're staying top of mind and posting and engaging with your audience constantly so you don't get lost in all the noise. And I was doing some research before this call, and I found a study by a social media influencer agency. They're called Obviously, and they found that over the last 2 weeks, there's been a 76% increase in daily accumulated likes on Instagram ads over the last 2 weeks compared to the previous year. And then they also found out that other social media channels just had on average a 27% increase in traffic and post likes and post engagement, again, just in the last 2 weeks. You know, it's not unexpected, but it's crazy how much of an increase that is. So with people being on social media 76% more, that means that you have to be on social media and that you have to be engaging 76% more as well, like I mentioned, so you don't get lost in all the noise.
Hey, Andrew, can I just add one thing to that?
Yeah.
The other thing, and I don't know, this is somewhat anecdotally, I guess, there's no Harvard study behind it, but what we also spend a decent amount of money on Facebook and Instagram and Twitter, getting our marketing out to our past clients, and also some databases of what are they called? Custom audiences, out to our custom audiences that we want to market to. And what I've noticed is our cost per lead has come down from about $50 per lead to about $30 per lead, and our number of leads have gone up. So to your point, there's more people spending more time on social media because they've got to pass the hours somehow. And also, I think there's less competitors in the space right now. So I'm just reaffirming your point. From a dollar cost averaging, we've never generated leads at this frequency and this low a cost.
Yeah, that's such a good point. It really is such an amazing time. And if you can really get intentional about who you're targeting and start to segment that audience, then like Josh said, you'll see a crazy return on investment. And Colin will go into that a little bit on the next slide. But kind of going back to what I was talking about, so the question becomes, obviously you have to start creating a lot of content, but what kind of content is best to create during this time? And our number one tip that we like to recommend is just to focus on connection. You know, one of the hardest parts of that marketers face is trying to define your target audience and figuring out what behaviors your audience has and what matters to them so you can better market to them. But with the state of the world right now, that hard part has actually become one of the easiest parts because everyone's up to the exact same thing, right? Everyone's staying at home, worried about their health, their family's health, their financial situation, and wondering what the future is going to look like. And so this is a great opportunity to speak to those concerns because you actually know those concerns. It's hard to come across as disingenuous or as having false empathy for people when you're going through the exact same thing as everyone else is. And the best way to make this connection is through video. And if you've done any research on digital marketing at all, you know that you have to start creating video content. It's so important. Especially now, because just go back to the fact that everyone is sitting at home, and not only are they starved for personal connection, kind of like what Josh said at the beginning of the call, but everyone actually has time now to consume long form video content. And when we say long form, we talk about usually video content between 3 and 4 minutes is considered long form. And even better, everyone knows that taking social distancing seriously, then you are supposed to be at home. So no one is expecting highly produced, high quality, polished video content from you because you're just sitting at home with a webcam. So that makes it so much easier and hopefully kind of takes the pressure off for you creating a video because, like I mentioned, there's really no way for you to get that amazing high quality video content. My partner is actually a loan officer in our branch, and I always have such a hard time getting him to create, you know, I say to him all the time, you just gotta turn on the camera and get comfortable on the camera so you can connect with people more. But there's always excuses about, oh, you know, no, I need to get a haircut, or I don't have time to create a perfectly polished script, or this, and this. The excuses, you know, that we all make up all the time. But those have really gone out the window now. Obviously, you don't look like you crawled out of bed, but again, like I said it before, no one is expecting super high polished video content from you. They just want to know what's going on in the market, and they just want some connection from you. So you can just jump on, turn on your webcam, turn on your phone, and say things like, hey, you know I don't look the best. Quarantine's kind of getting the best of me, just like I know everyone else is. But I just wanted to jump on and give you a quick update on what's moving in the market in Utah, and then talk for 2 minutes, and then sign off. And it's also a great time, and one of the bullets here is to maybe start a video series, just like a weekly housing update for Utah about just what's going on in the market. Like I mentioned, ensuring everyone that things are still moving, people are still buying homes, people are still selling homes, even in this wild world we're living in. Just provide that weekly touch point and stay consistent with it, so people know that you are someone that they can go to for a weekly update if they have been looking to buy their home or are going to be looking to sell their home. It's also a good time to maybe interview some other professionals in the space. Maybe jump on and interview a loan officer, a credit repair specialist, or a mortgage servicer, or even maybe a small business owner that you know who's been affected in some way by the virus. It's such a good time. Like I mentioned before, and Josh mentioned, people are starved for connections. So this is a really good time to take the opportunity to just connect your connections. At Fairway, we're all about being the guide, not the hero. And in order to be the guy, you just need to give your audience and your client base the tools that they need to succeed, and just point them down the right path. So interviewing other people, other experts in the industry is going to be a great way to not only build your network, but to also introduce other people and just be that guy I was talking about. And kind of going back, all this isn't to say that you shouldn't stop marketing yourself like you have been. Continue to post your listings, continue to share client testimonials just like you have been doing. Continue to leverage your email list and continue those weekly touch points. We like to say at least send a weekly email at a minimum. But you just want to make sure, like I said, that you're kind of increasing the frequency and also increasing that connection with your clients. So I'm going to turn the time over to Colin to talk about, now that you know about some content you can create, Colin's going to talk about how you can go about promoting that content and getting it out to a wider audience.
Hey, Andrew, can I just say two things about what you just said?
Yes.
I had 3 different clients in the last, I don't know, week to 2 weeks say to me that we were talking about in context of a refinance, and I'll always ask them, you know, what do you think the value of your home is now? And 3 different clients came back to me and said, well, I have no idea now that this COVID-19 issue's hit. Can we even get an appraisal? What's happening to home values? So people are a little freaked out that this thing has already put a major dent in Utah home values. And I don't believe that to be the case. Correct me if I'm wrong, but I think most segments of the market have not seen depreciation, like at least several of my clients think that they have. So reaching out and having conversations or social media posts around home values, I think is directly speaking into the conversation that's going on inside your clients' heads. And I think that would be really valuable right now. The other thing that I think would be really valuable right now is that there's this, all of this legislation around the grants and the forbearance, and maybe getting a CPA, an attorney, something like that, to get online and explain what all this legislation means, who can use it. That could be super valuable in terms of finding a local expert to interview. All right, that's all I had. Colin, I'm going to turn it over to you, my friend. I'm moving to the next slide.
Yes, sir.
All right, there it is.
All right, so you guys want to make sure you're promoting your content. We have a couple ideas here for you to use. You want to use your email lists. I bet most of you have a database with all your past clients, your leads, prospects, partners. What you can actually do is a couple things. You can send out weekly emails. We've been doing that. Andrew, we've probably been doing that for close to a month now, right?
Yeah, I think
And
so.
our loan officers are telling us that they're getting so much more engagement and replies with our emails that we're sending out. And it's usually just, like Josh said, what's on the mind of everybody right now. We're answering questions. And probably a good idea for you guys to do is, if you're talking to a client and they ask you a question, just write it down. And those questions, just create them into different content. What you can actually do is you can also upload those email addresses into Facebook and send this content that you create directly to them without them even liking your pages. That's called a custom audience. And if you guys have any other questions on that, I can definitely answer them. But you just want to get this stuff all on your social medias. We've just recently created this advertisement for this realty company. What they did was he filmed a video of himself talking about how the coronavirus is impacting the housing market in Utah. He went over pricing and how offers and mortgages are falling through. We took that and he wrote it as an article. We just posted it on Facebook, just to Utah in general. And he's already got over, I believe it's at 350 views. He's had about 20 emails and a handful of calls. So you just want to make sure you're getting all this content online in front of the correct people. And just reach out to your past clients, because your past clients are going to be the lowest hanging fruit right now. So yeah, does anybody have any questions for us at all?
Peggy has a question.
I do. Yes. So talking about, this is probably an Andrew question, maybe a Colin, that analysis via paralysis. We have started interviewing local businesses and checking in with them to say, hey, mostly restaurants right now, but there's some other ones too, like, hey, how can we support you? And so we're getting out their pickup and their curbside menus and just kind of getting to know them a little bit better, rather than just, oh, that Mexican restaurant that we go to every Friday night. And it's been pretty successful. And now we're thinking, okay, well, where else can we put this? So we're putting it on our team real estate page, and our individual agents within the team are putting it on our own personal Facebook pages. I checked in with the Chamber of Commerce today, and they are saying, yeah, just tag us. You know, I understand they want to control their content, but where else, if we're talking with local business, where else can we get our messages out if we're taking advantage of interviewing local businesses?
I love that. I think one thing Colin mentioned is leveraging your email list. So when they subscribe to an email list or give you their email, they're expecting for you to email them. And there have been studies showing that people will actually are able to, handle 3 to 4 emails a week from one company without unsubscribing. So it's an awesome way to get your content out there. Also, there are a lot of Facebook groups that have been popping up right now of people kind of just banding together and creating a community around the virus. And a lot of them are focused on small businesses that need help during this time. So I think if you just jump on Facebook and in the search bar type small business coronavirus, you'll probably get several different Facebook groups that are just designed to get the word out about small businesses and that have been created by people who are just looking to help. I think that'd be a great idea.
Okay, and then just real quick, do you have a recommended length on the video?
So,
oh, go ahead. Sorry.
Facebook is actually, they put out some statistics that said the average amount of video viewed on Facebook is between 3 and 4 minutes. So people will actually, a Facebook video, people will stick around and pretty much watch the entire thing. So our advice, Colin, you'd probably echo this, is the longer the better for video.
Yep.
Okay. Because they're like 10 to 15 minutes, and I figure people can bail out whenever they want, but they can at least start.
I think that's great. That should.
It also depends on what you want to achieve. If you're creating advertisements, I personally would, with the different stats and stuff that we run, I would keep videos under 30 seconds. If you keep a video under 30 seconds, it can be viewed in a lot more locations. But if you're just creating content that you want to post out on your page, and even to boost out, I would keep it, around up to 3 to 4 minutes. I think if you pass the 5-minute mark, it's starting to stretch, but I definitely agree with Andrew there. And just another quick tip, make sure you are using, why did I just lose it?
I'm sorry, make sure we're using what?
What was that, Andrew?
Closed caption, is that what you're
Closed caption, there you go. Sorry, it went right out of my mind as I was telling you. Make sure that closed captions to all videos. Sorry about that.
No worries. Yeah, so Peggy, just to add some additional clarity on that, I think we have to understand the differences of our videos. Like the video here on Fitness Realty probably has a call to action, like, watch this video and then reach out to me for your CMA. I'm just saying that could be a potential call to action. Well, if you've got a strong call to action and you want someone to take the next step, burying it 15 minutes into a video probably isn't the right way to do it. But if you've got an ad, like this is an ad, he's boosting this to his database of past clients and all of his leads, and he's asking them to watch a video and take a next step. And that video, to Colin's point, should be short. If you're more wanting to stay top of mind and you're building a relationship with your past clients, and it's more of a branding video, I'm not just Peggy the realtor, I'm the digital mayor of this city, and I'm an ambassador to all of our small businesses, and you're like building a community, then that longer format content is way deeper, and you're creating deeper relationships. And I'm assuming at the end you're not saying, and don't forget to call me for your real estate listings, right? It's not that it's not that ad.
My first couple, I didn't do that, and then I thought, now wait a minute, I'm giving, I'm coming from a place of contribution, but I do throw like a 15-second, hey, we're still in business doing our thing too. If there's anybody that we can help, reach out to us, blah blah blah.
I love it.
But it's not blatant. It's not in your face, and I'm not trying to use this as a sly reason to, I'm going to advertise. I'm going to talk to you for 10 minutes and then get my 15 seconds in first. That really wouldn't work, but I don't want it to come off like I'm trying to take advantage of them. I really want their message to get out there because we need to keep these people afloat.
Yeah. To me, that's a branding post and a relationship post. And then you've just inserted the fact that, hey, I still want to serve you, and there's still real estate happening. Let me know if it's a post where you're just trying to get somebody to take the next step. Like, for example, give me your email and current phone number, right? Then that's a shorter video message that gets somebody to take that next step.
Yeah, no, it's the former.
Okay, cool. That was a great question. Let's see, Sydney. Any advice on turning on captions? Tried this with our last video, and Facebook has updated, and I believe it's a little different. You know anything about that, Colin or Andrew?
Facebook did update them a little bit, but it's still quite easy to do. There's an actual automated system now that they use, and when you upload a video, I believe it's just on the right-hand side. You click and choose your language, and it should do it for you, and then you can go in and edit. But it still should be pretty simple right now.
Could you take a screen screenshot and shoot it over to me, and I'll send it over to Jeff and Lynn, and they can and I can send it to Sydney, and they can circulate it.
Yeah. Andrew, have you seen anything different or updated just recently? I believe it should still be the same.
Yep, no, I think you do have to update it through it might just be on a Facebook business page, actually. So Colin, you might want to look into that.
That's true.
If you're uploading on your personal, it might be a little different, but we'll look for you.
Just a couple weeks ago, I don't think you could do it on a personal page. It is only through a business page. So if you want any captions, make sure you do it through the actual business page. Good ad. Thank you, Andrew.
Okay, guys, we got to move quickly through this recap because I don't know if you remember, but we were supposed to be on a different Zoom meeting for our loan officers 3 minutes ago. So let's do a quick recap, and then we can take any additional questions probably by email if that's okay. So to summarize, we've got tighter underwriting guidelines due to decreased liquidity among servicers, changing the industry for everyone. We're going to see that as a trending case this year in 2020. Ask for all the documents ASAP and pay special attention to credit scores, debt to income ratio, and likelihood of job losses. That's what's going to be right in the crosshairs for realtors, or for underwriters, excuse me. And for buyer's agents, send buyers back to their lenders for requalification. Ask for automated underwriting approvals that are recent, and if they can guarantee to do a 17-day close or a very quick close turn time, I think you can use that as leverage when making offers to a seller and to a listing agent. Hey, listen, everybody knows the lending market is changing fast. Here's my automated underwriting approval for my client as of yesterday. My lender has everything they need and can close this deal in 2 weeks. We're going to close it faster than the underwriting guidelines can change. That should be valuable to your seller. And one other thing that I've seen agents do recently, we've had a few clients get cold feet. And so I had a couple of realtors do this brilliantly. They were in contract, buyer was about to cancel, and instead they countered the seller and said, hey, my buyer's getting a little freaked out over what's going on with coronavirus. They're not sure they want to put down all their money for the down payment. I'm trying to keep them in contract. Is there any way you'd cover their closing costs? Because if the seller's willing to cover their closing costs, that'd save them 3 months worth of mortgage payment, and that may make them comfortable enough to stay in contract. So that's just a little tip. I've seen that done by a couple of realtors recently. It's worked really well. And then digital marketing tips: increase your frequency and leverage your email lists. It's okay to communicate more now because we know the things that people are concerned about and we can speak directly to it. Target your past clients with specialized video showing you are the expert on the crisis. And I think, one last thing I would say is you could be an expert on empathy. People are, struggling right now, and anything you can do to bring a little sunshine to their day, I think is very, very valuable. Be patient and optimistic. All right, everybody, that's all we got. And thank you very much for the opportunity to come chat with you today. Jeff, Lynn, any other questions top of mind?
No questions, just gratitude, and we appreciate you and all the knowledge you just imparted to us. And so we all have jobs to do to represent our clients, and this is going to be super, super helpful.
My pleasure. It's great to be with y'all. And if you have any questions, you can email me directly. I can forward to Vicky and to Andrew and to Colin, and we're here to serve you in this trying time, and we will get through this. Thank you very much.
All right, guys, Josh needs to jump off and get to another call. If you guys want to stay on and have any other Q&A or mastermind, we got a few more minutes. So Josh, thank you so much. We'll talk soon, brother.
My pleasure. Thank you all.